Hi everyone. So welcome to the stream today. Very much excited for having you on the stream. Uh, we are continuing with the executive session with the Nhyira Premium. And this week we are putting it down so that I'll be able to answer all of your questions for you. For those of you who are watching us on YouTube, the meeting ID is in the chat box in case you want to join the Zoom meeting and be able to speak to me directly and ask your questions directly. You can do that by looking at the meeting ID and then joining the meeting. Also, you can put your questions in the chat box. I'm going to be reading all of your questions and replying to all of your questions on YouTube. And I will also be taking your questions as well on the Zoom call. All I want you to do is that you give us a thumbs up on the video on YouTube. That way, YouTube is able to get a notification and they will be able to push the video more so that we can reach as much people as possible. When you do that, you are helping us to be able to reach a lot of people in relation to that. So I see some people on the call here. I see Jemima, I see Victor Brown. We are going to get into the question and answer session any moment soon. So if you have any question, you know what to do already. You click on the raise your hand button and then I will call you up to come and ask your questions in relation to that. For those of you watching on YouTube, thumbs up on the video. That would be great for us. And then I see a comment from Ruben Blonya on YouTube. He said, I'm traveling at the moment, but I will download later. Okay, Ruben, take care of yourself and make sure that you stay safe. All right. So today we're focusing on two key subjects. Yesterday we were supposed to look at a strategic case study, but we realized that the management accounting students actually covered everything that we were supposed to look out for. So we didn't get time to talk about strategic case study. For that reason, today I decided to add the strategic case study again to financial management because when it comes to the financial perspectives of strategic case study, everything there is actually in financial management. It is for this reason that I did the merge of the two subjects again to enable us to be able to handle all of the issues that we couldn't handle yesterday in strategic case study. So you comment in the chat box with all of your questions, and those on the Zoom call, if you have any questions, you raise your hand and then we'll be getting into the Q&A session just any moment from now. Okay, so I see someone raising their hand. I'm going to call you in a moment. So you come in. Okay, so on YouTube, Ruben said, thank you, sir. You're welcome. So for those of you watching on YouTube, comment in the chat box with all of your questions. I want to hear from you. We're focusing today on strategic case study and then financial management. So whatever questions you have, throw them at me in the chat box. And I've put also the meeting ID in the chat box in case you want to join the Zoom meeting. You can just pick the ID and then you join us in relation to that. But all of you watching on YouTube, I'll be very much excited if you give us a thumbs up on the video. That way YouTube will see the video being more engaging and they will push it for us to get more views and to get more people to watch it in relation to that. So Victor, you can come in. I guess you have a question, you raise your hand. So you can come in.
Good evening, sir.
Yeah, good evening. How are you?
I'm fine. You are welcome for today's lesson, sir.
Yeah.
We thank you for yesterday. In fact, I enjoyed the class yesterday, which is
Okay.
management accounting.
That's right.
Actually, I'm also a financial management student, so I'll go more into financial management.
Okay.
Please, our calculation of equity financing.
Yeah.
The theory aspect, in fact, for that one, I can read and understand. But when it comes to the calculation, please, can you brief me on that, a gist on how the calculation is done, so that I can get a clear understanding about that? Thank you, sir.
Okay, so if I should get your question well, Victor, what you're saying here is that when it comes to the issue about business finance, you can read the issue in relation to that. But when it comes to the computation in relation to how you can calculate cost of capital, cost of equity, is that your question?
I mean the equity financing as a topic, its computation.
Okay,
Yeah.
so equity finance. And so I'm asking, your question is around calculation of cost of equity. Is that your
Yeah. Yes.
okay? So when it comes to computation of that, let me share my device with you guys. So for those of you watching on YouTube, comment below with your question. Ernest Ampofo said, thank you for your support. You are welcome, Ernest. If you have any questions, you put it in the chat box. And for those of you watching on YouTube, give us a thumbs up on the video. That way we get more engagement and YouTube will push the video for us to get more more views. And that is what we want to grow our channel very well in that case. And you can comment with your questions in that case. So our first question is coming on business finance, but to be specific, equity finance. So when it comes to calculating cost of equity, that is KE, there are various methods that can be used to calculate the cost of equity. So when it comes to calculating the cost of equity, among other things, we can use the dividend valuation module. We can also use the capital asset pricing module. Now, when it comes to calculating the cost of capital using the dividend module, there are also two formulas under that. We have the constant dividend approach and then the constant growth in dividend approach for that issue. So let's look at the first one, you calculating the cost of equity using the cost of the dividend approach. So with that, we say KE equals DO over PO. This is where we are assuming that the entity pays now certainly times 100. Okay, so this is where we are assuming that the entity is paying constant dividend. So there is a constant dividend that the entity is paying. But the DO that you see above there is the dividend that the company has just paid. Dividend that the company has just paid. So if I should pull a scenario up and we say that, okay, for instance, the organization pays a dividend of say 1.5 or $1.2 per share. And then the market value per share, let's say that is given to us as, let's say, $20. So if we want to calculate the cost of equity, that is KE, it is simply going to be KE equals the $1.2 divided by the $20, and that's going to be times 100 because KE has to be expressed in percentages. So if I should punch that out real quick, you can also punch that 1.2 divided by 20 times 100. And I think that gives us somewhere like 6%. I don't know if I'm right. So that's 6%. And that becomes the cost of equity. Now, like I told you, this will be done assuming the company said, or the question said, dividend has just been paid. Now, sometimes the examiner will say dividend is about to be paid, about to be paid. Now, if dividend is about to be paid, one thing you must understand is that always the market value we have here, that is the PO, must be the ex-div market value. Now, when we say ex-div market value, what does that mean? It means the market value that excludes dividend. The market value that excludes dividend. So what does that mean? It means if the company has just paid dividend, it means when you buy the shares now, you won't receive dividend this year, but you will start receiving dividend next year. But if the company is about to pay dividend, that means if you buy the shares right now, you are going to be receiving dividend this year as part of the company's policy of the organization. So let's flip this question up and let's assume that in this case, the company is about to pay dividend. So if they are about to pay dividend, how do we then calculate the cost of equity? So I'm gonna rub my notepad here. So if the company is about to pay dividend, then we say that KE equals still DO, and the dividend is 1.2 over, we will subtract the dividend from the market value, because if the company is about to be paying dividend, that means the market value is cum div. So we have to take out the dividend component, and that will be 20 minus 1.2 times 100. So that we can get the PO ex div. So when we look at that, that will be 1.2 over 20 minus 1.2 times 100. And that's going to give us somewhere like 6.4% approximately. So that is how we calculate the cost of capital, sorry, the cost of equity for a company. Always read the question very well to identify whether dividend is about to be paid or dividend has already been paid. So this is the first aspect, assuming we are using constant dividend. The second aspect is when there is what is called constant growth in dividend. So if in the question, we realize that there is a constant growth. So if there is a question, in the question, we realize there is a constant growth in dividend or dividend is growing, what do we do then? What we do then is that we have to use the other formula. So let me clean my notepad. And remember, these formulas will be given to you in the exam hall though. Just that you must also know them offhand so that in case the examiner makes some typo errors, which should not be happening, but could happen. So that is going to be DO 1 plus J over PO plus J. Am I right about this? Let me confirm this formula, okay? I want to make sure I'm not giving you bomb already. Yeah. So that is going to be the growth. Now the G here represents what is called the cost of, the growth rate. The G represents the growth rate. Now the growth rate can be computed. I will not go through the calculation of the growth rate though, but we can use past dividend to calculate the growth rate. In that case, G will be equal to the nth root of final dividend over initial dividend, all minus 1. So this is where we are giving historical dividend. So maybe we are giving 5 years dividend, and we are supposed to calculate the growth in the dividend before we can calculate the cost of equity. So in that case, what we do is that if it is 5 years, the N here will be 4. Then we'll bring the last year, that is the current year dividend, and then the first year, that is the initial dividend, minus 1 times 100, and that will give us the growth rate. So this is the formula we use, assuming we are calculating the growth rate from historical dividend. But another way we can calculate the growth rate is through what is called Gordon approximation. That we say that the G equals R times B, where the R is the current required rate of return of reinvestment of the retained earnings of the company, and then the B represents the percentage of profit retained. The percentage of profit retained. So all of that may be provided to us in the question, or the examiner may tell you that the company makes a profit of 20 million and they paid a dividend of 6 million. That means they retained 14 million. So you have to calculate 40 million over the total dividend, over the total profit to get a percentage of profit retained. So this is how we will use the growth rate. So the growth rates can be either we are giving historical dividends, or we will be using the Gordon approximation approach in relation to that. Now, once we calculate the growth method, the growth figure, or maybe it's given to us directly in the question, we just substitute it into the formula, and then we get our cost of equity in relation to that. So these are the two ways that we will be able to compute the cost of equity using the dividend approach, whether the entity is paying constant dividend or there is a constant growth in dividend for the organization in relation to that. Now, there is a limitation about the dividend method using it to calculate the cost of equity for an organization. The limitation is that it doesn't consider risk in the shares, and also dividend is not having a constant growth in actual reality, and so it is not a reliable method to really use to calculate the cost of capital or the cost of equity of the organization. For that reason, a better method to calculate the cost of equity for an organization is the issue in relation to the capital asset pricing module, and that is CAMP, capital asset pricing module. So if we are using the capital asset pricing module, let me clear my notepad real quick. That one, we say the CAMP will be equal to the risk-free rate plus the beta of the shares minus the return on the market minus risk-free rates. Very, very important in relation to that. So the risk-free rates minus, plus the equity beta into brackets return on the market RM minus RF. Now, the beta here represent, now when we say beta, beta simply represents the riskiness of the shares, okay, the risk of the shares. So the beta will be given or may be given to us in the question, and we will use that to calculate. The risk-free rate simply means the interest rate on facilities like government bonds, because with government bonds, treasury bills, and those ones, don't incur any risks on them, because whether you like it or not, you'll be receiving the benefit at the end of the day. So then the return on the market refers to the returns that the entire market is giving, and chances are we will be giving that in the question as well in relation to that. But this is where you have to get the understanding very well. The beta you see here is the equity beta. Now, there are two types of beta. We have asset beta and equity beta. The asset beta is the risk of the market, of the industry, whilst the equity beta is the risk associated with the shares of a company. All the time, our focus is in the equity beta all the time. But there are times when if we are diversifying, so let's say we are an educational institute and we are going into, let's say, manufacturing, then to find out the cost of capital we will use to appraise our project, we cannot use our current capital asset pricing module or cost of equity. We have to get the asset beta of that industry and use it to re-gear to be able to get an equity beta that will help us to calculate the capital asset pricing module. So if you talk about calculating the cost of equity, Victor, this is what you have to understand. I don't know if I've answered your question the way you want it to be answered.
Yes, sir. So in this case, I've understood the first two from the dividends ones. Yeah. So this one is the beta. Will they give it to us, or you have to calculate for the beta?
It's given to you if the examiner wants you to just calculate the capital asset pricing module. But like I said, there are times when the examiner or the company will be diversifying. So if the company is diversifying and we are calculating the cost of equity, then the examiner may give us an asset beta, and we will use that to re-gear to calculate the equity beta for the organization in relation to that. And that one, maybe let me throw the formula up for that, the asset beta formula. Then I'll help you to understand what you are saying well. So let me share my screen. This may not be something that the examiner will throw at you in your FM exam, but who knows? So the asset beta formula, which is BA, equals VE, that is value of equity, divided by VE plus VD into bracket 1 minus T, where T is the tax rate, multiplied by the equity beta, which is BE. So this is the formula in relation to that. So the BA is the asset beta. Like I told you, the asset beta is the riskiness of the entire market, of the whole industry. The equity beta is the risk that is involved in the shares of a company. T here is the tax rate. VE is the value of equity, which is your market value per share times the total number of shares. And then VD will also be computed. I know you may know this already, so I will not go into that. So assuming in the exam, the company is diversifying, like I told you, the company is diversifying. And the examiner said, at what is the cost of capital that we can use in order to appraise the project? Then in that case, we will come back to this formula because the examiner will give us the asset beta for that industry. Which means, so like say an educational industry going into a manufacturing industry. So they will give us the riskiness of the manufacturing industry, which is the asset beta. Then we will use that and then we will calculate a new equity beta, which will now come and use that equity beta in our capital asset pricing module formula to calculate the cost of equity, which will be used to appraise our project in relation to that. Do you understand?
Yes, sir. Thank you so much.
All right, you're welcome. Okay, so I see a couple of people joining: Owusu, Al Hassan, Isaac, Charlotte iPhone, Nana. So all of you who have joined, we're looking at financial management and we're looking at strategic case study today. So if you have any questions, you just click on the more button below your screen. You will see raised hand, and then you'll be able to raise your hand and I will call you in so you can ask your questions in relation to that. For those of you watching on YouTube also, you can comment in the chat box with your questions and I'll be answering all of your questions for you. And then also consider giving us a thumbs up on the video so that I will be able to, or we will be able to get more engagement on the video so YouTube can push it to other viewers. Okay, so Jemima Amuzu, you can come in now.
Yeah, good afternoon, sir.
Yeah, good afternoon. How are you?
I'm fine, thank you. And you?
Yeah, I'm also fine.
Okay, sir, please, with the internal rate of returns, in case they don't give you the two rates, do you compute it yourself or you just guess, or you have to draw a graph to look for it, or how do you find it?
Excellent. So let me come in. When it comes to internal rate of return, to excel in calculating the internal rate of return, you always use what is called a trial and error. That is it. Now, when I say trial and error, what does that mean? What it means is that definitely you know you are going to be calculating two MPVs. So always, this is what I tell my students. Start with 10%. It's a trial and error. So start with 10%. So for the first MPV schedule you're going to do, start with 10%. Then when you get a 10%, from that, the answer you get for the first MPV will tell you whether you should increase the rate or you should reduce the rate. So that is how you'll be able to calculate the IRR. Use the trial and error approach. The first one, start with 10%. The answer you get will now inform you whether you should increase the rate or reduce the rate to be able to calculate your IRR. Jemima, you good?
Okay, sir, thank you.
All right, welcome. Okay, so for those of you on the stream here on Zoom, like I said, if you have any questions, you use the more button, you raise your hand, and then I will be able to call you up for you to ask your questions. And those of you watching on YouTube also, the same thing. You comment in the chat box with your questions. But if you want to move from YouTube and come and join us on Zoom, the meeting ID also is available in the chat box. I think 8900-200-4875, 8900-200-4875. That's the meeting ID. And you can join us on Zoom here and ask your questions directly. Okay. Now, so when it comes to, as I wait on a couple of questions from you guys, I'll be sharing as well a couple of things with you. When it comes to the issue about financial management, I tell students that it is one of the cheapest subjects to pass by our standards. And the reason why it's one of the cheapest subjects to pass is that you know definitely that there is going to be questions on the various topics that you are studying. So definitely we know there's going to be a question on business finance. And when it comes to business finance, two key issues as always there. We're looking at where do we get the money from, which is the sources of finance, and then what is the cost of that money, and that is the cost of capital. So certainly when it comes to the issue about sources of finance, you must also understand the issue about long-term sources of finance, how the company will be able to raise long-term sources of finance, and then the various short-term sources of finance. Then along the line with long-term, short-term, it's also the issue about Islamic finance. It's also an area that you have to look out for when it comes to sources of finance. Now, in the long term, what is going to be happening is that we are going to be raising money, usually following the pecking order theory. So we go to retained earnings, come to debt finance, come to equity finance. But what is going to be happening is that we will go to debt finance. And when it comes to debt finance, we are talking about various types of debt. There is bank loans, there is bank overdraft, bank loans, debentures, loan notes, and other forms of loan facilities that can be issued on the capital market of the Ghana Stock Exchange to be able to enable us to raise funding in relation to that. Then in the short term, sorry, still in the long term, aside debt finance, we can have equity finance. And with equity finance, we need to ask ourselves a question. Is the company listed or the company is not listed? If the company is listed, then the company can do a public offer, meaning issuing shares to the general public using at the current market value. So a company can do a public offer for the equity finance, or the company can do public offer by tender. Now, public offer by tender is where the entity is issuing new shares to the general public, but usually the market value of the share is not quoted. So more or less like the potential investors are going to bid, and once they bid, the shares will be issued to the highest bidder in relation to that. So that is the public issue or public offer by tender. Then we come to the third one, which is going to be the issue in relation to right issue. Right issues has to do with the issue of new shares to existing shareholders in their current in their current shareholding ratio. So for right issue, it is available only to existing shareholders in relation to that. Then aside that, there is also one method available to listed companies, and I think that is a sponsored issue? I've forgotten the actual name for that. Maybe if I remember as we go ahead, I will let you know about it. But with this one, what happens is that the company issue the shares, but the merchant bank stands in and sells the shares to its customers or its clients in relation to that. So here, but as always, at least 25% of the shares must be available to the general public for them to buy in relation to that. So for a company that is listed, it can choose any of these options to raise finance. Now, a company that is not listed may decide to either become listed so that it can do an initial IPO, initial public offer, or it can remain unlisted and then will undertake a private right issue by issuing the shares to the shareholders, the existing shareholders it has in relation to that. So that is the issue about long-term sources of finance. And you must also look at the issue in relation to the effect on the shareholders' wealth should a company make a right issue, whether their wealth would increase. Because you see, when a company makes a right issue, shareholders can, among other things, do certain things. Number one, a shareholder may decide not to do anything. A shareholder may decide to subscribe to the right issue. Then another group of shareholders may decide to subscribe to the right issue and sell it. Now, any of these three actions or decisions by the shareholders will have an effect on their wealth. Whether their wealth will remain the same, their wealth will go up, or their wealth will drastically reduce in relation to that. So that is the issue about long-term sources of finance. Then we come to the short-term sources of finance. Now, in the short term, trade payables, technically, is a source of finance for an organization. Bank overdraft is a short-term finance for the organization. Then also the issue about short-term bank loans. Now, sometimes it will be favorable or best for an entity to go for a short-term bank loan rather than a bank overdraft. Why? Because with a short-term bank loan, a deadline is set, so we know a fixed date is set, and so the money will be paid at that fixed date, maybe 3 months short-term bank loan. But with bank overdraft, once you overdraw the money, when the money hits the account quickly, it will be deducted. But if it is a short-term loan, when money hits our account, it will not be deducted until the date due for the deduction or the date due for the loan repayment is done. So sometimes, instead of bank overdraft, companies may be required to rather go for a short-term bank loan within 3 months, 6 months in relation to that. So that is also about short-term sources of finance. Then we come to the last aspect, which is Islamic finance. And when it comes to Islamic finance, a couple of issues can be mentioned there in relation to the various types of instruments that are used in Islamic finance. like Muduraba, Shakuk. But the key concept is that the Islam religion actually prohibits interest. So you cannot make interest when you give money to people. So they rather find other ways in order for the provider of finance to benefit from the finance that has been provided to the other party in relation to that. So basically, when it comes to where do we get the money from, these are the kind of things that we will look at about sources of finance in relation to that. Again, for those of you who are watching on YouTube, give us a thumbs up on the video to make it more engaging so that YouTube can promote it to other viewers. And if you have not subscribed to the channel, also subscribe to the channel and become part of the family. But most importantly, I want you to comment below with your questions. We are looking at financial management and strategic case study today. So you comment below with all of your questions. And for those of you here on the Zoom call, you can raise your hand if you have any question by clicking on the more button, and I'll be able to call you in so you can ask your questions as I share other stuffs with you as well in relation to that. So that is the first aspect of business finance. That is, where do we get the money from? Sources of finance. Now, after we ask ourselves, where do we get the money from? Money is not free. So the second question we ask is, what is the cost of money? And that is what we mean by the cost of capital. And that was where David asked a question about cost of equity, and we went through Victor asked a question about cost of equity, and we went through all of that. So that is about business finance. And certainly, whether you like it or not, there is a question waiting for you about sources of finance, either Islamic finance, long-term sources or short-term. There is a question waiting for you there. And then calculation of cost of capital, whether you like it or not, there is a question waiting for you there on that. Now, if the examiner wants to really stretch you out, then he will set a question, he will put a question on the WACC, that is the weighted average cost of capital. Because you know, when it comes to the weighted average cost of capital, we are looking at getting the funding from the two sources, that is equity and debt. So if the examiner wants to look at how you are going to be excelling when it comes to the weighted cost of capital calculation, he will request you to do the weighted average cost of capital, so that literally you will do cost of equity and you will do cost of debt in relation to that. So these are the things that you must understand. But a final takeaway I want you to have also is that when it comes to calculating the cost of debt, that is KE, before you calculate the cost of debt, you have to ask yourself, is the debt redeemable or irredeemable? Because if the debt is redeemable, the computation is different. And if the debt is irredeemable, the computation is also different. For a simple illustration, if the debt is irredeemable, that is where you will say KD equals I over PO, which is interest over market value of the debt, assuming we are not taking tax into consideration. But you know, debt is tax deductible. So, sorry, KD, not KE. So KD will be I over PO 1 minus T, which means we are putting in tax. So in case we want to build tax into the calculation of cost of equity, which is a critical aspect, then we use the second formula. This is if the debt is irredeemable. Please note that the interest you are bringing is simply the interest rate on $100 or 100 Ghana cedis or 100 pound nominal bond, period. So if the interest rate is 10%, you just do 10% of 100, and that will give you $10, and you divide that by the market value per $100 bond, and then that will give you the cost of debt in that case. In the question, if there is tax, then you have to use the second formula. But if there is no tax in the question, then you can go with the first formula in relation to that. So if the debt is irredeemable, this is how we go about it. Now, again, all these formulas will be given to you in the exam, but like I said, you must know them offhand. This is not about chewing baba. You know, I'm not a fan of Baba, so it's not about chewing Baba. It's about understanding the concept and being able to quote the formula in relation to that and know what the formula actually represents. Because the examiner will give you the formula, but he won't give you what each of them actually stand for. Now, if the debt is redeemable, then we say that the cost of debt is equal to internal rate of return. So that is where you will use the internal rate of return concept, like Jemima asked earlier, the trial and error approach, so that you will discount the cash flow on the debt in order for you to calculate the cost of debt for the organization. So for pro forma purposes, assuming the debt is redeemable, the pro forma set out is that we'll bring the cost of the bond, which is an outflow. We'll bring the annual interest, which is an inflow. Then we'll bring the redemption in relation to that. Now, be careful here. The interest can be interest before tax or interest after tax, but usually if there is tax in the question, you have to bring the interest after tax. Now, the interest is always going to be the number of years. So for instance, when it comes to the discounting actually, you know, the cost of the bond will be discounted at 0 years. So that one, it will always at 0. But the interest, you are going to use the annuity factor to discount that. Then on the redemption, you use the present value factor for that day of redemption as the discount factor to get your present values. So be careful about that. The interests are discounted using the annuity factor, and the redemption will be discounted using the present value approach, or the present value factor from the discount table in relation to that. Remember I said you're going to be looking at the issue in relation to trial and error here again, in that case, because the interest you will compute, you are going to be using the coupon rate on the bond to get your interest, and then you can do your discounting either at 10%. Like I said, always start at 10%, and then you'll be able to go about that in relation to that. Then the final thing is about the redemption. Now, this redemption value here can be computed actually from various sources. The first source is that upon the date of redemption, there are some times when the shares or the bond can be converted into shares. So especially if the bond is a convertible bond. So if it is a convertible bond, then certainly at the date of conversion, we must look at the value of the shares at the date of conversion, and then the value of cash that the bondholders will receive if they were redeeming. The one that is bigger will become the redemption value in relation to that. So either they are converting into shares or they are taking their cash in relation to that. So depending on the question and whether these will be there in relation to that. So basically, when it comes to business finance, these are a couple of principles that you must understand in relation to the treatment about that. So those of you watching on YouTube, comment in the chat box with all of your questions and give us a thumbs up on the video. That way we get more engagement, like I said. And for those of you who are on Zoom here with me, if you have any questions, click on the raised your hand button and I will call you in for you to ask your questions in relation to that. Okay. So that is a key aspect of the syllabus. And we know that there will be a question on that in the exam hall. So if I'm writing financial management, there is no way I'm going to screw myself because I know certainly the examiner will set the question on this. Now, somebody is going to say, oh, Nhyira, so how do you know This is the structure of the question. And sometimes the examiner will say something that you will not be able to understand. This is my statement or my reply to that. Build your understanding on the computation of cost of equity very well. Solve as much questions as possible. Now, anytime I talk about solve as much questions as possible, I'm not talking about ICA past questions. For ICA past questions, you can solve that. But you have to go outside the ICA past questions, get some ACCA questions to solve them as well in relation to that, because these will build your understanding much better as you prepare yourself for the exam. So take note of that and also consider that. Now, aside the issue in relation to business finance, another key hot area in the exam hall is going to be business valuation. And I think it's one of the topics that, I don't know if we have a content on that on our channel though, but business valuation, one of my favorite areas when it comes to financial management. How do we value a business? How do we value a business? Now, whatever I've discussed already about business finance, for those of you doing strategic case study, it's critical for you guys as well in relation to that. Now, business valuation is an interesting area because there are various reasons why a business will be valued. Number one, a business will be valued if it wants to do an initial IPO. So it wants to do an initial public offer, then they have to place a value. So like MTN, when they were doing their initial IPO, they engaged a couple of firms to be able to value the MTN company. That was why they were able to come up with the IPO share price of 75 pesos per share. So one reason why an entity will be valued is because they want to go public. They want to be listed on the Ghana Stock Exchange market or the UK Stock Exchange market or whatever, the New York Stock Exchange market in relation to that. Another reason why a company would want to be valued, it's because it just wants to raise funding, not through initial IPO that is not going to public, but maybe having venture capitalist company coming on board. So if a venture capitalist company is coming on board and they want to invest in us, one thing they want to look at is to value the company. I don't know if you have watched Shark Tank before on CNBC, I guess, and people come and they pitch the sharks with their businesses and they will say, we are looking for, say, $6 million. Okay, so quickly they will be able to now be for 25%. So quickly they will be able to do the math and place a value on the company. So if you are bringing an investor on board, you don't want to go to public, but you are bringing an investor on board, bringing a venture capitalist on board, then you would have to value your company in relation to that. So that is the second reason why a company can be valued. Another reason that a company will want to be valued is when there is an acquisition. So for instance, we want to acquire a company. So if we want to acquire a company, what do? We have to go and value them. Or we are a company and somebody wants to come and acquire us, then we have to place a value upon us. So when there is an acquisition bid, definitely there has to be a valuation of the company in relation to that. So initial IPO, raising funding from venture capitalists, acquisition bid, then sometimes another reason the company can value, not because he wants to raise finance, not because he has received any acquisition bid, but he just wants to value the company for just the shareholders' purposes. So just the shareholders want to know whether the value of the company has gone up or the value of the company is reducing. So sometimes the shareholders will want to just know the value of their shares, the value of the company, and so that if in case they want to sell, they will know how much they can sell that in relation to that. So just for the shareholders' purposes, they would also want to value the company in relation to that. So these are some reasons. There could be other reasons that I didn't raise, but these are the 4 key reasons that we could talk about. Then if an entity is valuing a business, there are various methods that it can use to value the business. Now, I'm not going to be going through that in detail today because it's a Q&A session. I need to also stop and then take your questions as well. We have the asset valuation module. We have the price earnings ratio module. We have the earnings yield module. So maybe let me just list them up here for you guys. I know you know these already. Got some sharks around here, you know. So let's see what we got there. So methods of valuation. So we have the asset valuation module. We have the dividend valuation module. We have the price earnings module. We have the earnings yield to be able to use that to value the business. And we can also use the cash flow. That is the free cash flow module to also place a value on the business. So asset valuation module, dividend valuation module, price earnings ratio, earnings yield, free cash flow, that can also be used in valuing the company in relation to that. Now, you have to determine or understand the reasons behind each of the formulas. Now, if, for instance, we want to acquire a company, and as we send them the acquisition bid, the shareholders tell us that we will not accept anything below $20 million. Why would they want to do that? So if we want to value that company or such a company, what method will be more favorable for us? Because the shareholders are saying that a minimum, at least, whatever, they will accept $20 million. And that is at most $20 million. So we want to find out the reason why they are placing such a value on their business. So one way to find out the reason why they are placing value on their business is to use the asset module, so that we value the business based on the asset base. So probably the reason why they are placing that kind of value on the company is because of the assets they have. Maybe they have a research facility, or they have a state-of-the-art factory, or they have some infrastructure asset that is costing them, or that is motivating them to charge that kind of money. So the asset method could be used favorably, assuming we are giving that minimum bid in relation to that. Also, if that minimum bid is given, we would also sometimes assign the asset valuation module to use the free cash flow concept. The free cash flow concept simply means how much cash will be left for the shareholders after the entity pays all providers of finance, undertake all capital expenditure and any other thing. How much money will be left at the end of the day? That is what we mean by the free cash flow. So at the end of the day, we want to find out, okay, do they have a lot of free cash flows? That is why they are demanding that. Then it will be a good news for us in relation to that, because there are some companies, they have a huge cash flow. So maybe they are charging us $20 million, but they have like $5 million already in the bank. So if you check technically, if we should buy that company right now, because they have $5 million already in the bank, which is free cash, then we're actually paying only $50 million for the business. So in valuing them, we could use the asset valuation module and then the concept of free cash flow. Then other times, we may want to acquire a business, not for continuity of the business, but we are acquiring the business just to take certain assets of the business and then we will wind up the business. For such a reason, if we are acquiring such a business, we will want to place a value of the business using the asset valuation module, so that we will value the company based on the assets that they have in the organization. But if we want to have a continuing interest in the company, and we want to find out the ability of the entity to pay dividend on an annual or yearly basis, then a great method we can use to value the business is the dividend valuation module. So if we want to have a continuing interest and we want to assess the ability of the entity to pay dividends, then we can use the dividend valuation module in relation to that. But there are sometimes the fact that a company is paying dividend now does not mean it will be able to pay dividend in the future. So for us to also have a continuing interest in the company and also determine the future earnings potential of the entity, the future earnings potential of the organization, we will use the price earnings ratio, which gives us an idea about the future earnings potential of the organization. Because using the price earnings ratio, the value of the company is going to be equal to the price earnings multiplied by the earnings of the company. So price earnings ratio multiplied by the earnings of the company. So in case we want to have a continuing interest and we want to assess the future earnings potential of the company, then we'll be using the price earnings ratio. So it is not just about knowing the formulas, chewing them, and quoting them by heart. You must know and understand which will be appropriate. Because there are sometimes the examiner can put you on the spot and he will ask you to value a business. And in valuing the business, you may be using, say, 3 methods to value the business. Maybe the asset method, the dividend valuation method, and then the price earnings yield method. Under that kind of circumstance, at the end of the day, you have to conclude which of the methods you can rely on, or which of the method can place a reliable value on the company. And to decide which method is okay, we must understand the objectives of the company, whether they want to have a continuing interest, whether the shareholders are asking a minimum amount, or whether they want to just acquire it because they have a research facility and they want to take that facility and then scrap the rest of the business in relation to that. So that is also about the methods that we can use about business or under business valuation. So let me pause here a little bit so that I can see if I can address some questions so far. So for those of you watching on YouTube, put it in the chat box, whatever questions you have. And for those of you who are here on the Zoom call, you can click on the raise your hand button, and then I'll get a signal. Then I will call you to ask your questions in relation to that. So let's see, YouTube. If you have any questions, put it in the comment box, sorry, the chat box in relation to that. Unless you are watching the playback, then the comment box will work for you in that case. Okay, I see Owusu, you raised your hand. Yeah, Owusu, you can unmute your mic and then you can talk. Hello.
Good.
I think your network, it's bad, quite bad.
Hello, can you hear me very well?
Yeah, I think I can hear you. Yes.
I'm saying that I'm very appreciative of what you just explained about the valuation method. It's quite understandable. At first, I was finding it difficult to understand, but it's not very clear.
Okay.
That before you use any of the method, you should know the objective of the company before you use the method in the company.
That's right.
So thank you very much.
Okay. You're welcome. You're welcome. So if you have any questions, you know what to do. Raise your hand, I'll call you in, then you ask your questions. YouTube, put it in the chat box. I'm gonna be answering all of your questions as well on the chat box or from the chat box. I don't know today where my strategic case study students are at. Yesterday they were here, but today, I don't know. Okay, let's just proceed. Now, so that is the second aspect of the syllabus. Whether you like it or not, business valuation, the examiner will examine you on it. So if I were you, I will understand all of these methods and then learn how to deal with them very well. Now, if you're an old school financial management student, this may be the first time you are hearing the concept of free cash flow. In the old syllabus, it was in advanced financial management. But now that there is only one financial management in the syllabus, the concept of free cash flow has actually been pushed to level 2. So in addition to understanding all these, the concept of free cash flow is very, very important as well in that case. So that's the second aspect, business valuation. So business finance, sources of finance, we will get a question there. Cost of capital, we will get a question there. Business valuation, we'll get a question there. Then we come to your favorite topic. That one, everybody likes it, and it's called investment appraisal. Investment appraisal. So it's a done deal area. Definitely the examiner is going to be setting a question from the investment appraisal. Now, when it comes to the concept about investment appraisal, it's one of the fundamental decisions in financial management. Remember, I think I said this yesterday. I don't know if I said it yesterday though, but when it comes to financial management, there are 4 key decisions. It is these 4 key decisions that are summarized into the whole topics when it comes to financial management: investment decisions, financing decisions, dividend decisions, and then the risk management decisions. So investment decisions is actually one of the key decisions that the company makes. And to appraise investments and to decide whether the company can pursue an investment or not, we have to appraise the investment. But usually, there are 2 things you must understand: how investment is appraised by not-for-profit making organization and then for-profit making organization. Now, when it comes to not-for-profit making organization, they are not there for returns. They are there to maximize the welfare of the shareholders. For that reason, a project may have a negative net present value, but they will still go ahead and undertake the project. Why? Because they are not looking for return. They are not looking to maximize the wealth of the shareholders. They are looking to maximize the welfare of the beneficiaries. So when it comes to not-for-profit making organization, they don't have any weighted average cost of capital. All they have is an already computed cost of capital that they will use to appraise all of their projects in relation to that. But for profit-making organizations, they will only undertake a project that will maximize the wealth of the shareholders. For that reason, the project will be discounted using the current weighted average cost of capital of the organization. Now, I'm using the word weighted average cost of capital in the context that the company is going to raise money from both debt and equity. But if it is purely equity, then we'll be dealing with the capital asset pricing module or the dividend valuation module. Then if it is debt and equity, then the weighted average cost of capital will come in relation to that. So the difference in between these 2 guys are very important. The fact that the objectives are different, the fact that the discounting factor they use is going to be different, and the fact that the final decision they make as a result of the outcome of the analysis will also be different based on their objective. Now, in a nutshell, there are about 3 stages when it comes to making investment decisions. We have what is called idea generation. We have what is called idea screening. We have what is called investment appraisal and analysis, which is the thing we are looking at. And then the number 4, implementation and monitoring. Idea generation, because ideas can come from various aspects of the organization. Now, when you say various aspects, ideas can come from the board of directors. So the board can decide what kind of projects we want to undertake. The production department will say, let's bring a new product out, or let's buy a new plant and equipment. The sales and department will say, let's buy a new delivery van, all of that. The accounting department or finance department will also say, let's buy a new accounting software. So there are various projects, various ideas that will be generated from the organization. So we can start with 10 ideas. That's the first step. But the fact that the company has 10 ideas does not mean it can actually implement all the 10 ideas. Why? Because capital is limited. The company has a budget. The company has an objective. So with all of that, we come to the second stage, and that is called idea or project screening. So this is where all the 10 ideas will be screened based on various criteria of the organization. So is it part of the strategic goal of the organization? Is it part of the strategic objective of the organization? Is it a project within the capital budget of the organization? Is it a project that will maximize the wealth of the shareholders? Is it a project that will increase our market share? Is it a project that will cause us to have competitive advantage? So these are some questions that the company will ask to screen all of these ideas. So at the idea generation stage, the company may have 10 ideas, but after the screening, you realize that of the 10 ideas, only 3 can make it to the next stage. And from there, we come to the third stage, and that is going to be the issue in relation to investment appraisal, which is where we're going to be looking at in detail in a moment. So where we appraise the project using the various methods, payback period, discounted payback, internal rate of return, net present value, and those methods there. Then once we appraise the project, every method has its decision rule. I'll be taking you through them in a moment. And then once we look at that, then we can now select a project, and then we implement the project, and we're monitoring the project in relation to that. So these are the stages that projects go through. It's called a project stage, or the stages involved in investment appraisal or investment decision making in that case. So if we are screening, if we are financially assessing the company or assessing the project, there are various methods that we can use as a company. So what are these methods that we can use? I've already mentioned them, and the decision rule for each of them is different. The first one is the payback period. The payback period simply measures how long it takes an entity to generate cash inflows equal to the capital outflow of the project. So if we undertake a project and we incurred $20 million, how long will it take us to make the $20 million from the project? The decision rule here is that the shorter the payback period, the better it is for the company. The shorter the payback period, the better it is for the company. But there is a limitation on the payback period that we must be aware of. Number one, it doesn't take into consideration the time value of money, because it doesn't take into consideration the time value of money. It just look at the cash flow, but $2,000 tomorrow will not be the same as $2,000 today. So it doesn't take into consideration time value of money. Second thing, it doesn't consider the cash flows after the payback period. So after the payback period, it doesn't consider the cash flow after the payback period. That is another limitation that we can talk about. Also, it doesn't take into consideration the issue or the effect of tax that we must consider in relation to that. So these are a couple of limitations about the payback period. But like I said, the decision rule is that the shorter the period, the better it is for the company. Usually, the company will use the payback period to compare 2 projects. So, and let me say this, when it comes to projects, there are 2 types of projects. We have mutually inclusive projects and mutually exclusive projects. When we say projects are mutually inclusive, it means they are interrelated, they are interconnected, and one cannot be undertaken without the other. So mutually inclusive projects. But if the projects are mutually exclusive, it means they are independent on their own, and they can be undertaken separately by the organization to achieve its objective. So if projects are mutually exclusive, then we can use the payback period, and the one that gives us the shortest payback period, we'll be choosing that in relation to that. Or there are some times where the company will have its own payback period. So if the project is 1, we will compare the payback period from the project against the company's benchmark payback period. When it is lower than the company's benchmark, then we undertake the project. If it is higher than the company's benchmark, then we ignore the project in relation to that. So that is the first method that we use to evaluate NPV projects. Please, if you have any questions, I see someone just joining, I think Kin. If you have any questions, you click on the more button, you will see raise your hand, and you'll be able to raise your hand, and then I will call you in to ask your questions. This is a Q&A session, but more or less like I'm teaching throughout today. And then for those of you watching on YouTube, in the chat box, you can put your comments in there. If you want to join the Zoom meeting also, the meeting ID detail available or is available in the chat box, and give us a thumbs up on the video on YouTube so we get more engagement and the videos can be pushed for others to watch as well. Then the second method, now, because the payback period doesn't consider the time value of money, another way we can appraise the project is the, okay, I'm coming. Owusu, is your hand up? Or is the old one? Okay, I guess it's the old one. Now, so because the payback period doesn't take into consideration the time value of money, the second method is the discounted payback period. Okay, Victor has raised his hand. You can come in.
I said it was about the discounted. So when I realized that you have written it, it's okay. I'll listen to that, sir.
Okay. So the second approach is the discounted payback period. Now with the discounted payback period, here we are taking into consideration what? The time value of money. Okay, so we will discount the cash flows using the company's current cost of capital to be able to determine whether we should undertake the project or we should not undertake the project. Again, the shorter the period, the better it is for the company. But let me set out the pro forma for you for the payback period and the discounted payback period. So let's set out the pro forma. I'm going to try to divide my screen into two like this. I think one should be a bit bigger than the other. Whoa, my pencil is not responding. Let me see. Okay, good now. All right. So let's divide, and let me give you the pro forma for this. Now, if we are doing payback, it's simple. We'll just bring year, we'll bring cash flow, then we'll bring cumulative cash flow. That's all. And always the cost of the project will come to year zero, and that will be an outflow. That will be an outflow. Then every year, the cash we get will be an inflow. We'll deduct that from this, and we will get this. So till we get a positive figure, and then we'll calculate the payback. But when you're dealing with the cumulative cash flow, the pro forma is going to be quite different. We're going to have year, we'll have cash flow, we'll have the discount factor, then we'll have the present value, then we'll have the cumulative cash flow. So that's the pro forma that we set out for the discounted cash flow. We have the year, we have the cash flow, we have the discount factor. Note that the discount factor here is the company's cost of capital. So the current cost of capital of the company will be used to discount the cash flows in relation to that. Yeah, Olupo Stephen, hi. I believe you are doing well. I think you just joined the stream on YouTube. So that is the pro forma for the payback period, and then the discounted payback period. Now, it's very important for you to get the answer at the end of the day. The way you get your payback period answer is that the year that there are two things you're going to have. you will see that if the project has 5 years, maybe you got a positive in the 4th year. Now, if you got a positive in the 4th year, that doesn't mean the payback period is 4. It means that the payback period will be 3 years plus how much money that was left for you to go to the positive divided by the cash flow that came before you went to, for you to go to the positive times 1 year. When you do that arithmetic, that will give you the payback period. So you pick the year before the positive plus the cash flow before the positive divided by the cash flow that came in for you to go to the positive times 1 year. That gives you the payback period. So these are the two methods about that. Victor, are you okay? Because you wanted to ask a question about.
Yes, sir. I'm okay, sir.
Okay. All right. So payback period, discounted payback period. Then the next one we go for is the accounting rate of return. The accounting rate of return. Now, like I said, when it comes to the discounted payback, the decision rule is the same thing. The shorter the period, the better it is for the company. So when it comes to the accounting rate of return, this is where we're looking at the returns that we are going to be making from the project. So formula-wise, we say that it is the average profit divided by average investment. Average profit divided by average investment. Please note that it is average profit after depreciation. That's very, very important. It's always average profit after depreciation. And the average investment is always equal to the cost of the project plus working capital plus scrap value divided by 2 in relation to that. And the decision rule, now this figure is times 100. So whatever we get times 100, because it has to be in percentages. The decision rule is this. When it comes to the accounting rate of return, we compare it to the current cost of capital of the company. If the accounting rate of return is more than the current cost of capital of the company, then we accept the project. But if the accounting rate of return is less than the current cost of capital of the company, then we reject the project in relation to that. So that is also about the accounting rate of return and the decision rule about that. Then we come to your favorite area, and that is the NPV schedule. I love that. The NPV and his brother, IRR, are the favorites of the examiner. For some reason, the examiner likes to bring them almost all semester, like changing them up, NPV and then the IRR. Now, the idea about NPV is that, you know, the payback period and all of that did not consider tax, did not consider capital allowance, so did not consider the issue about inflation and all that. So in order to enable the entity to really understand and appraise the project well, the NPV schedule is a preferred approach in relation to that. So with the NPV schedule, this is where all the cash flows on the project will be brought, taking into consideration working capital, taking into consideration capital allowance. And for those of you who joined yesterday, I did the capital allowance schedule in man accounting. Is the same concept. We did that yesterday. Capital allowance, and then the issue about tax will also be brought. But when it comes to the NPV schedule, you must understand when the tax is payable. Please note that tax can be payable immediately. That is, as and when cash flows come in, or it can be paid in arrears. So in the question, when you see an NPV question, don't just jump and start doing it. The schedule you do will depend on how the tax is paid. Now, if tax is paid immediately, or tax is paid in the year or as and when cash inflows are earned, then if the project has a life of 5 years, then our NPV schedule will be 0 to 5. But if tax is paid 1 year in arrears, then even if the project has a life of 5 years, we will do 6 years. Why? Because the tax for year 1 will be paid in year 2, year 2, year 3, year 3, year 4, in that order. So it's very, very important for you to understand how tax is paid when we are dealing with the NPV schedule in relation to that. Then the final thing that is that all working capital inflows will become an outflow. Sorry, all capital outflow will become an inflow at the end of the project. So when you're dealing with NPV, you must take note that all the capital outflow about working capital will be coming in at the end of the project as an inflow in relation to that. Note that absorption of overheads is not a relevant cost when we are doing NPV. And then the issue in relation to depreciation is not considered here. That is why we give you capital allowance. Then any other overheads, general overheads expenses will not be considered when we are dealing with your NPV schedule. The decision rule here is that if the project has a positive NPV, then we accept the project. And if the project has a negative NPV, certainly we reject the project. Why? Because the ultimate goal is that the project must increase the wealth of the shareholders. The project must increase the wealth of the shareholders, or yes, must increase the wealth of the shareholders. So if it has a positive NPV, it means it will increase the wealth of the shareholders. But if it has a negative NPV, it means it cannot increase the wealth of the shareholders. It will be reducing the wealth of the shareholders to undertake the project in relation to that. Then the last thing there is the IRR, which is the internal rate of return, and we've spoken about that indirectly. Now, the internal rate of return concept, the internal rate of return is simply the rate at which cash inflows of the project will be reinvested. The internal rate of return is the rate at which cash inflows from the project will be reinvested. In a simple language, the decision rule is that if the internal rate of return is greater than the company's cost of capital, then we accept the project. But if the internal rate of return is less than the current cost of capital of the company, then we reject the project in relation to that. So the rate at which the cash inflows from the project is reinvested is what we mean by the internal rate of return. Like I said, anytime you're dealing with the internal rate of return, you go with a trial and error approach. You start always with 10% as the starting point. And based on the results you get, you can either have increased the rate or reduce the rate in relation to that. So these are some things also that you have to understand when it comes to dealing with investment appraisal in relation to that. So any questions for me? If you have any questions, for those of you on Zoom here, you raise your hand, you click on the raise hand button, and I'll get a notification, I'll call you in. For those of you watching on YouTube also, you can comment below with your questions, and I'll be answering all of them as well here on the stream. Let's see. Okay. All right, Jemima, you can come in.
Sir, please, yes. So please, with the investment appraisal, which formula, like when do we use the formulas you just listed, like the various approach?
All right. So if the entity is interested in repayment of the initial capital, then they would look at the payback period. So if they are not thinking about the long term, whatever it is, they want to find out as early as when can I get my money back? As early as when can I get my money back? Then they will go for the payback period. But if they want to really take into consideration all other factors and appraise the project in the light of all other factors like tax, working capital, and every other information required to really appraise the project, then they will go for the NPV schedule. The internal rate of return, it's a rate that comes in because the entity wants to find out, okay, the returns that we are making, at what rate can we reinvest it? That is why they would want to go for the internal rate of return. So if the company wants to find out, okay, the inflows we are having from the project, at what rate can we reinvest it? Then they will go for the internal rate of return in relation to that. But this is not in your ICA syllabus, no, but if you do financial management or corporate finance in the advanced level, there is what is called the modified internal rate of return, where really you don't reinvest your inflows at the internal rate of return. You reinvest your inflows at the current cost of capital of the company. So the modified rate of return will give us a better rate than the internal rate of return. But at this level, we just take care of that. So if we are interested in getting the rate at which we can reinvest the inflows, we go for the internal rate of return. Then there are some times where the company wants to look at the project from an accountant's perspective. So if you want to look at the returns we are getting from an accountant's perspective, which is similar to what is called ROCE, return on capital employed, then that is where they will use the accounting rate of return. Because if you look at the accounting rate of return carefully, you realize that it is similar to the return on capital employed in relation to that. So if they want to look at a project from the perspective of an accountant and want to look at how much returns we can make from this project, whether we are making more returns or less returns, then they will go for the accounting rate of return. So Jemima, these are some reasons that we can talk about. You good?
Okay, thank you.
All right, you're welcome. TechnoSpark 4. Okay, I see someone's hand is up. I think Victor, you can come in.
Please, it's about the NPV.
Yeah.
Do inflation also affect in financial management about the NPV? That's what I want to know, sir.
You said, come again. I didn't get that well.
Inflation.
Yeah.
Does it occur in financial management?
It occurs. So
okay. Because
I don't know.
Hit on that.
You know the concept. I didn't hit on that. Okay, so maybe let me talk about that quickly in that case. Now, I think it's a key aspect. It escaped me to talk about that, so thank you for the question. When it comes to the cash flows in investment appraisal, there are two things you have to understand. Cash flow can be in real terms, and cash flow can be in nominal terms. Now, when we say cash flows are in real terms, it means the current cash flows. It means it excludes inflation. It means that is the current money you're going to be getting. But when we say nominal cash flows, these are cash flows that include inflation. It means we've taken into consideration the time value of money, how much the money will be in the future. So these two things you have to understand. Why is this important? Because if cash flows are in real terms, then we must discount it using the real cost of capital. Then if cash flows are in nominal terms, then we must discount it using the nominal cost of capital. What does that mean? It means that when a company, or we are giving the current cash flows in current terms, but the examiner gives us the nominal after-tax cost of capital, then we have to either put inflation on the real cash flows to bring them into nominal terms. Then we can use the after-tax cost of capital given to us to appraise the project or to discount the cash flows, or we can still use the current or the real cash flow given to us. Then we will use the Fisher formula to be able to now calculate the real cost of capital. Now, the Fisher formula, let me put that down as well for you to let you know how we move from the real cost of capital to the nominal cost of capital. So the Fisher formula is 1 plus I equals 1 plus R. So let me put it down real quick. Okay. So let me erase these guys up. So the Fisher formula is used to find your rate moving from real rate to nominal rate. So that is 1 plus I, bracket close, equals 1 plus H, and then 1 plus R, where the H is the inflation rate given to us in the question, the R is the real rate, and then the I is the nominal rate in relation to that. So that is how we deal with the Fisher formula, and this will be able to help you to move from the real rate to the nominal rate when we are dealing with inflation in that case. Victor, are you okay?
Yes, sir. I'm okay, sir.
All right. So any questions, you raise your hand and I'll call you in for you to ask your questions in that case. And on YouTube, you can comment below with your questions as well. I see a comment from Olupo Steven said, what of if the tax is in advance? Okay, usually when it comes to investment appraisal, usually the tax will be paid either at the end of the year or immediately. But if the tax is in advance, meaning that you have to actually pay the tax before the start of the year in relation to that. So meaning that in that case, we will actually take it back. So the tax for year 1 will be paid in year 0. The tax for year 2 will be paid in year 1, like in that case. So if tax is in advance, in case there is anything like that in the question, then we will rather push the tax back. So year 1 tax will be paid in year 0. Year 2 tax will be paid in year 1, because it means the tax must be paid at the beginning of the year in relation to that. Any other questions for me? On WhatsApp, sorry, on YouTube, as well as on the Zoom call here. Let's see if I have any other questions. All right. So we've looked at the issue about business finance. We've looked at the issue about business valuation. We've looked at the issue about investment appraisal. Now, then the last aspect of your syllabus, now I've not spoken about the theory areas. There are theory questions that the examiner will set, which is the beginning of your book, sorry, and I will not go through that. The issue about the capital markets, the money markets, the objectives of the organization, like those kind of things. If you take your financial management book, like the first 86 pages, I don't know if it is 86 or 70 something pages, it's theory. So in that aspect, you may have a 10-mark question coming from that area. So you can spend your time to read some things there. Just that it's bulky at that place, but you just focus on the issues about the capital market, the money market, that is the types of market, and then the objectives of the organization, and then the various other things in the introduction. So those are the theory areas, and I'm not going to be going through that. So the last aspect will be risk management, and this is also critical for those of you doing strategic case study. And I think I introduced you guys to this one as well yesterday, risk management. Two things comes to mind when we talk about risk management. That is foreign currency risk, and then the interest rate risk. But the big question we need to ask ourselves is, why these risks? The foreign currency risk comes in because the entity engages in international trade. So if the entity engages in international trade, then it will be exposed to the foreign currency risk. Now, international trade in this context means whether the entity sells outside or buys from outside. So if the entity sells, then it is due to receive money. Now, if it is due to receive money, it can either suffer foreign currency loss or it can make a gain. Then if it is buying raw materials from, say, China, as everybody almost buy things now from China, then we are going to be actually incurring foreign currency loss as well. Now, somebody may ask, Nhyira, it's not all the time that the thing is a loss. Sometimes it can be a gain. You see, as financial managers and CFOs, we are not thinking about the good aspect. We are just thinking about the bad aspect and find out how we can reduce the bad thing. So that is the thing we think about. We are not thinking about the good aspect. We are thinking about the bad aspect. Because if you realize in Ghana, for instance, you realize the way our currency is dancing. Every day we are told that the currency is being arrested, but no arrest has been made yet. We don't know when the arrest will be made though. But you realize that the currency, the exchange rate is going up. So if you are a company that buys from outside and you have to pay in dollars, it means how much money you got to pay is actually going to be more than how much you would have paid if you had bought the goods some time ago. So we want to find out, how can we hedge ourselves against this? And I'll come to that in a moment. Then sometimes for companies to undertake projects like investment decisions, remember what I told you is about long-term sources of finance. They have to borrow from the banks. But maybe the project is due to take off in 2 years' time, in 3 years' time. Should we wait till when we are about to start a project and go to the bank for the loan? No. If we wait, the interest rates will go up. So if that is the case, how do we hedge ourselves against increase in the loan rates or borrowing rates of the organization? That is the issue about the interest rate. Again, the borrowing rates can actually fall. But like I said, we are not thinking about the positive. We are always speculating what is the negative aspect and how we can save ourselves. And that is one of the key roles of the CFO of the organization. So the question is, how do we deal with these risks? It boils down to one word, and that is called hedging. Hedging. So hedging simply means that it's a process where the entity finds ways and means to reduce the impact of the risks on the organization. So when it comes to foreign currency risks, let me just discuss a couple of hedging methods with you. Then I would look at a couple of questions as well from you guys. So we have the internal methods and then the external methods. Why is my marker coming? Let me see. Looks like the device is getting tired already. Okay. Let's see if it is better now. So hedging. So hedging techniques. Like I said, we have the internal hedging techniques. So internal and then external. When we say internal techniques, it means the entity does not involve outsiders in hedging itself against the foreign currency risk. And when we say the external method, it means that it engages other third parties in hedging itself against the risk. So what are some of the internal approach? The internal approach or technique involve invoicing in home country currency. Invoicing in home country currency. That is why if you go and buy something in China, they won't invoice it in Ghana cedis. They will invoice it in dollars or maybe in the yen, if the yen is better than the Ghana cedis. Why? Because they don't want to think about exchange rates. So if we invoice in our home country's currency, it means when you are paying us, you pay us with our what? Home currency. So once you are paying us with our home currency, there is no need for us to think about, oh, when we go and change the money, it will reduce or it will not reduce. So invoicing in home country currency is one of the internal methods that we can use. The next one is what is called matching. Now, matching simply, there is another name for this, but it has escaped me. If I remember, I'll let you know. If I don't, too, maybe some other time I'll talk to you about it. Matching. Now, the idea about matching is that sometimes an entity buys from outside and also sells in the outside world. So at the end of the day, what it will do is that when it sells to outsiders, it will receive foreign currency. So it can open a foreign account and then put the foreign currency there. Then when it buys, it will be paying in the foreign currency. So at the end of the day, the company will just look at the revenue it received in the foreign currency and use that revenue to pay for the expenditure. That is the matching idea. So in that case, you realize that it is not now we are going to convert the Ghana cedis into dollars. We already have a dollar account where we sell to people in dollars and we receive the money into the dollar account in relation to that. So that is also about the matching approach. Another thing we can talk about is the net off or netting. Netting off, something like that. Now the netting off is where this is where we deal with broad organizations, or the company has various departments or various segments. This is usually for group of companies. So for instance, I owe you, you owe me. So if that is the case, how much do I owe you? How much do you owe me? So use part of what I owe you to net off what you owe me. That's the idea about netting off. So maybe I owe you $10,000 and you owe me 20,000 Ghana cedis. Okay, when we find out your $10,000 converted into Ghana cedis, how much is it? Then you will use that to net off how much I owe you. Then we find out who will be balancing who. So you realize that at the end of the day, we are not relating to any other company. We are just using our internal procedures to be able to net off how much I owe you against how much you owe me. So invoicing in home country currency, matching, netting off, these are all internal methods. Then there is another one, I've forgotten that. Those of you on the Zoom call, is any of you, do you remember anything about the internal methods? Remaining one, I guess, but I can't take it. So maybe I'll just end it there. If I remember, I'll let you know. Then we come to the external techniques. Now, the external techniques is where the entity engages third parties in the arrangement of the hedge. The first one is my favorite, money market hedge. So this is where the entity borrows money, deposits it. So this is the idea. If we owe somebody in foreign currency, we are supposed to pay the person in foreign currency. What we will do is that we will go and borrow our currency, which is the present value of how much we owe them, and then we'll convert it to the foreign currency and put it in an investment account, so that when it is time to pay the person, we already have the foreign currency plus that investment, and we'll use it to pay the person in relation to that. But if we are due to receive some money, what is going to be happening is that we will borrow in the foreign currency and then convert it to our domestic currency, and then we will deposit it in an investment account. When the person pay us how much they owe us, what we do is that we just use that money straight up to pay for the foreign currency loan in relation to that. So that is the idea about the money market hedge. You have to understand how the treatment is done when the company is to make a payment, and how the treatment is done when the company is supposed to receive money. Aside the money market hedge, we also have the forward contracts. So this is where the entity arranges with the market or with the Forex Bureau or with the bank a rate at which they should exchange the currency in the future. So for instance, we are due to pay our suppliers in 3 months' time, $20,000. So we won't wait 3 months' time for us to exchange. We can go to the bank and say, hey, we want to exchange $20,000 3 months' time. What rates can you give us? So maybe currently the rate is $1 is 5.835. They can say, okay, in 3 months' time, they will give it to us at $1 for 5.921. So that is a forward contract. So at that time, now forward contract is legal, is binding. So with this one, when the time comes, we have to exchange the $20,000 at that rate that has been agreed. The deal here is that, assuming when you get there, the exchange rate has fallen, you still cannot do anything. You will still have to exchange at the agreed rate. But if you get there and the exchange rate has also increased, then it is to your benefit. The financial institution is going to be losing, but that is the forward contract in relation to that. Then the next thing is to talk about the issue about options. Options are like placing a bet on the market. So you can buy currency options, and then you can place a bet on the market, and once there is a movement, so right now you have 3 months to pay the money. So instead of going for a forward contract, or instead of doing a money market hedge, you can buy a 3 months foreign, a 3 months currency options in relation to that. And then at the end of the 3 months, you sell it up, you make some profit, and then you'll be able to use that to pay for the debt in relation to that. So options, it's also one of the techniques that we can use externally. Then we have also what is called swaps. Swaps. We have currency swaps, we have goods swaps, but in this case, we'll be focusing on currency swap. The idea about currency swap is this. It's usually done by two companies, usually in two different countries. So let's say I have a partner company in the UK, and they want to undertake an investment in Ghana. And I also want to buy something in the UK. Now, I need loan. If I go to UK at any bank in the UK to borrow, they don't know me, so they may not borrow to me. Or even if they know me in relation to that, okay, Olupo Steven has given me the fourth technique. I love that. Thank you very much, on YouTube. That is leading and lagging. Leading and lagging. That is the fourth internal technique, leading and lagging. Leading means you pay the money in advance, even prior to the receiving of the goods, whilst lagging means waiting to make the payments in the future. So this is more like strategic. So you realize that, okay, the way the exchange rate is going, it is going to go up going into the future. So what do? You even pay the money before the goods are delivered. That is called leading. But lagging means you read the exchange rate and you realize that it's going to fall somewhere in the future. So you don't pay for it, and you receive the goods and you make the payment later on in relation to that. Olupo Steven, thank you very much for that, leading and lagging. So currency swap, let's come back to that. So I was using an illustration. So a company, I have a partner company in the UK, and they want to do a business in Ghana, and I also want to buy something in the UK, but I don't have the money. I need to borrow some pounds. But if I go to any bank in the UK, they may not give me the loan. Or even if they will give me the loan, they will give it to me at a high interest rate. So what do? What we can do is that my partner company is in the UK, they know them, they have a good financial standing. I am in Ghana, the Ghanaian banks know me, I have a good financial standing. So what that we will do is that he needs Ghana cedis. I will borrow the Ghana cedis for him, and I also need the pounds. He will borrow the pounds on my behalf. Then at the end of the day, we exchange the currencies so that he will give me the pounds to be able to buy what I want to buy. Then I'll give him the Ghana cedis that we want to buy. All of us will deal with the interest rate, and at the end of the day, everybody will be paying the interest rate on behalf of the other person in relation to that. So this is the idea also about swaps. We can do that in relation to that. Not only currency, there is also goods swaps. So let's say maybe we are just in Ghana here. This is not about foreign currency though, but there is goods swap. So I'm just going there for you. Let's say we are in Ghana here, and let's say you are located in, give me a community in the northern region, maybe Wale Wale. Let's say you are located in Wale Wale and I'm in Accra. Now, let's say that the price of fish in Accra is cheaper than the price of fish in Wale Wale, which is not true though. Then somebody in Wale Wale can also buy millet at a lower price, because when they transport the millet to Accra, it becomes expensive. So what can we do? My partner in Wale Wale will buy the wheat, even though they don't need the wheat. Then I will also buy the fish here in Accra, even though I don't need the fish. So at the end of the day, we will swap. So I will give him the fish and he will give me the millet. At the end of the day, we determine the value, and whatever amount will be outstanding will be settled among us in relation to that. So that is also the issue about currency swaps about that. So these are a couple of techniques that we can use in order to hedge against foreign currency risks, the internal method and the external method. Please note, for theory purposes, should the examiner ask you what method the entity can use, you can mix them up, okay? But most important thing is explaining them in relation to that. But if the examiner emphasizes, then you have to be careful about that. Yes, Jemima, you can come on.
Sir, please, can you speak about mergers and acquisitions?
Mergers and acquisitions. Okay, possibly I'll do that. Let's see. I see somebody, Infinix Hot 6, I don't know. If you have any questions, you can raise your hand and I can touch on that. Yeah, Victor, you can come on. Before you come on, Victor, I'm coming. Now, for those of you watching on YouTube, you can comment below with any questions you have. And please give us a thumbs up on the video. That way the video is getting more engagement, and YouTube will be able to push it for other people just like you to watch, so that we can grow the channel better and get to more people in relation to that. So please give us a thumbs up on the video on YouTube. But most importantly, comment below with your questions, whatever questions you have, comment below with it, and then let's look at it. Yeah, Victor, come.
Sir, please, with the hedging,
yeah,
both the internal and external, it doesn't have any calculation to that effect.
No, it has.
Okay. That's what I wanted to know, sir.
It has, but I may not be able to go through that. I have done a detailed lecture videos on risk management on my channel. So when you go to the YouTube channel, you can check fundamentals of financial management. In that playlist, I think I did a 7-part series on risk management, and I covered all of these things with their calculations. Money market hedge has a key calculation. I covered that. Options, I covered that. Netting off, I covered that. Leading and lagging has no calculation because it's a theory area. Forward contract has a workings, so I covered that one as well. So you can watch those video on my YouTube channel and get all the calculations in relation to that. All right. Any other questions for me? Somebody talking?
Thank you. I was thanking you.
Okay, you are welcome, Victor. Now, also, Jemima asked about mergers and acquisitions. Mergers and acquisitions. This is a huge topic. Let's see if I can talk about it, talk about some key issues, very critical issues in relation to that. Now, when it comes to how an entity can expand and grow, there are 2 ways that can be achieved. We have what is called growth through organic. So there is what is called organic growth. And then there can also be growth through acquisitions, or if you want, mergers. So organic growth is where the entity starts from scratch. So it starts everything from scratch, uses its own resources, and to start a new business, to buy things, and then to grow in relation to that. That's not really our focus. There are limitations, there are advantages, disadvantages about organic growth, and then acquisition, growth through acquisition and mergers. I'm not going to go through that, but it is something you must understand, because the examiner can ask you reasons or the advantages of growth, organic growth, and growth through acquisitions. Now, mergers, like the name suggests, merger simply means 2 companies coming together to form a new company. Now, like MTN and Airtel did, hey, look at me, MTN and Airtel, Tigo and Airtel did to become Airtel Tigo. That is a merger arrangement. And then some of the banks, the financial institutions, did the merger also because to meet capital requirements. I think Atlantic Bank and then another bank did a merger, Omni Bank, and I think Sahel also did a merger, and some of the banks did a merger in order to meet the minimum capital requirement. And then Consolidated Bank is actually a merger of some of the banks in that case. So that's merger there. But acquisition is the sweet spot. This is where one company finds another company. So there are 2 things you must understand. There is one company called the target in relation to that. So we sit down and we find out, okay, we want to acquire another company, and that company becomes what? A target company. And then we send them an acquisition bid in relation to that. Now, there are various hindrances that can be put in place by an organization to prevent a potential acquisition or merger. Because you see, if I am a CEO of a company, then you have brought a bid to come and acquire us. Now, if you acquire us, I will lose my job. If you merge with us, I may lose my job, or I may be demoted. So in order to prevent that, sometimes the CEO, the board, will put in place some hindrances to convince shareholders not to accept the merger arrangement or the acquisition arrangement. Like for instance, you realize that with Airtel Tigo merger, before the merger, Lucy Quist left as the CEO of Airtel. I guess she left. Now, she left before the merger. Now, assuming she was there prior to the merger, she may not be the CEO of the new merged company. So she may be demoted in relation to that. So sometimes, in order to prevent that, some of the CEOs will put in place what? Some impediments or hindrances. Now, what are some of the hindrances that they can put in place in relation to that? They can tell or notify the shareholders that the company is a profitable company and hence shouldn't be disposed of. That is one way they can do that. Another way they can do that is to bring about some publications about certain things that the company is doing that would make it not to be attractive to the acquirer to come and bid for the company. So for instance, they can say immediately they receive the bid, they can publish a budget or a statement that, oh, their profits are declining, or their products are failing, or they are undertaking a corporate restructuring or corporate reorganization. Why are they doing that? They are doing that to discourage the acquirers from acquiring the business. Another way they can do that is that immediately they hear about a potential acquisition or merger, they will go for more debt, leverage finance. Now, who likes debt? Nobody. If you are coming to buy our company and we have a huge debt, you will be discouraged, because if you buy, you have to pay our debt for us. So in order to discourage the potential acquisition or potential merger, the CEO of the company can decide that, hey, let's be geared. Maybe currently their gearing ratio is just 30%. Immediately they hear about the acquisition, they will go for the loan, and their financiers or the bank will agree and give them the loan. And before you know it, they are like 70% GA. And you'll be discouraged, because if you come and buy them, you are paying the shareholders, and at the end of the year, you will pay the debt as well of the company in relation to that. So there are a couple of things that the CEOs or the company, the target company, can do to prevent a potential acquisition in relation to that. Now, aside these issues, we must talk about also financing of the acquisition. Now, there are various ways through which acquisition arrangements can be financed. Various ways through which acquisition arrangements can be financed. It can be financed through, first, share exchange for the consolidation or consolidated financial statement student or FR students. You know about this. So share exchange, it's one of the cheapest way to acquire a company. Why share exchange? Because we don't have money to give you guys. But listen, we want to give you a continuing interest in the company. For that reason, we will issue new shares to you guys so that we have acquired your company though, but instead of giving you the money, we are going to be giving you shares in that case. So sometimes it could be purely a share exchange. And this kind of acquisitions has actually occurred a lot, especially if you go to the US around last year and last 2 years, there were various acquisitions of CNN, various acquisitions of other companies, and they were involving issues about share exchange. Second way of financing is through cash. This is the hard part. And usually it's less. So imagine a company is valued as $80 billion and you're acquiring them. Sometimes the cash is not available to do that, but there is a cash financing also. Then there is also the leverage finance. So this is where the company will go and borrow money from the bank, from their financial or from their financial institution to come and pay for the acquisition. And they will place the debt on the balance sheet of the company they have acquired. It is to discourage future acquisitions. So I acquired you for $50 billion. They can go to the bank and borrow like $10 billion. And they will put that $10 billion on the financial statement of the company they have acquired. So if you too, you want to come and acquire, the gearing level of the company we just acquired may discourage you in relation to that. So leverage finance can also be used in that case. So share exchange, cash, leverage finance, these are all ways through which we can finance the issue about that. Then when it comes to acquisition also, there is what is called management buy-in and then management buy-out, MBI and then MBO. You see, when the shareholders decide to sell a company, like I told you earlier, the board of directors will lose their job. Yes, they will be given a huge redundancy salary package, but how long will they chop that money? They've worked all their life for this business, and all of a sudden it's going. So when they hear the shareholders selling the business like that, they may want to what? Buy it in relation to that. So that is where the concept about management buyout comes in, where the managers of the organization, the board, come together to buy the company from the shareholders so that now the company becomes theirs. Now, they have worked in the company, they know everything about the company, they know the earnings potential of the company, so certainly they will be in the right position to buy the company in relation to that. Other times, another group of managers from outside will come and buy the company and go away. And that is where management buy-in comes into the picture in relation to that, where external set of managers come and buy the business in relation to that. That is not what we want all the time as managers of an organization. But the question we ask ourselves is, how can the board of an organization finance the acquisition? How would they finance it? They may finance it through various sources. They may use their personal finance. So maybe all this while they've been saving some money, so they can use personal finance to finance the acquisition that they have arranged. Or they can also use leverage finance. You know, there are some CEOs that by themselves, they are business on their own. So their name alone can make them get as much money as possible that they want. So they can go to the bank and also borrow some money from the shareholders. And then another way, from the bank to pay the shareholders. Then another way they can finance it is to do what is called deferred payments. I love this one. This is where they will be paying the shareholders, but not now. So they can tell the shareholders, hey, can you guys give us some time? Give us some time. I mean, maybe give us 2 years or 3 years time, we're going to be paying you, taking into consideration the time value of money in relation to that. So technically, what happens is that the shareholders are actually lending the money that management was supposed to give them to the management of the organization. So they are supposed to pay them, say, $10 billion, but they will tell them, hey, we're going to pay you 5 years time. So that $10 billion will become a loan facility for the organization, and they will be paying interest on that. And in the 5th year, they will be able to raise money, usually to be internally generated fund, free cash, and they will use that to pay for the loan in relation to that. So these are a couple of things that I can come off head on. Let me just see if I skipped something about that. Now, definitely, if you are dealing with the issue about acquisition and mergers, you must know that business valuation is there, because if we are merging, we must value the business. If we are acquiring, we must also value the business in relation to that. So let me see if there is something else I need to cover. Okay. Then another thing, finally, that I would want to share with you on this merger and acquisition thing will be the issue in relation to economics of scales, because once we merge or once we acquire a company, we're going to be enjoying economics of skills. So when we are valuing acquisitions, when we are valuing mergers, we don't just look at the price earnings ratio to determine the mergers. We will look at any savings that we will have when we acquire the company. We will look at the economics of scale that we'll be enjoying as a company. So we will take into consideration all of those factors when we are valuing a company or acquiring a company or dealing with a merger and acquisition in relation to that. So these are some things I can talk about. Jemima, for acquisition and mergers. What do you think? Jemima, is it okay for you?
Yes, please. Thank you. But it's left one last thing about takeovers. Yes. About takeovers. Like one company, takeover.
Yeah.
Yes.
Takeover is the same as acquisitions. Turn on your mic and let's talk. Takeovers are the same as acquisitions. Okay.
Okay. I was thinking maybe an acquisition is maybe a percentage of the company. You are
relax.
Something.
Come again. Your line was breaking, so I didn't get you.
Oh, okay. I was saying that, like, my thoughts on the takeover and acquisitions is that an acquisition may be a percentage of the company, but a takeover would be like the whole company. You've bought the whole company.
Oh, okay.
If I'm right.
Okay. Yeah, you may be right, but an acquisition can also be 100% ownership. Acquisition doesn't mean you are just acquiring a part of a company. It can be a whole company. And takeover means that you are taking a whole company. But even takeovers, there may still be a percentage that will be retained by the shareholders. So they are used interchangeably, and in each of them or under each of them, there may be a full ownership, 100% ownership, or less than 100% ownership. Only that there will be the issue in relation to gaining control of the organization in relation to that. So usually they are used interchangeably, and they would all entail the issue about that. But for legal purposes, sometimes the word takeover will be used like what happens when Ghana Commercial Bank took over UT Bank and the other banks. So that kind of arrangement will be called takeover. They didn't acquire them because UT Bank, Ghana Commercial Bank didn't go to UT Bank and say, hey, you guys are struggling. We want to buy you guys. That would have been an acquisition. But you realize that the regulator, that is the Bank of Ghana, realized that UT Bank is not doing well. Okay, who can we bring on to manage the assets, take over the assets, and pay all liabilities comfortably? And that is why Ghana Commercial Bank and the whole Ghana, that was the company that was having the finances to be able to take over those companies. So in that context, we would say that kind of arrangement is a takeover, because they didn't say we are buying you. But if they had said we are buying you, then that would have been an acquisition. So that is also another extreme difference we can talk about in takeover. So in takeover, it could be that there's a legal regulatory requirement, or there's a regulator who said, hey, from today you can't operate. So allow this company to now come and take you up. That's a takeover. But if they are sitting there somewhere, like we say in Ghana, and the company comes and say, you guys are struggling, we want to buy you. What do you think? Then they said, okay, yeah, we are struggling, we will sell. Then they sell, then that will be the thing in relation to that. Jemima, do you get it?
Okay, sir, thank you.
All right. So let's see if we have some comments on YouTube. For those of you watching on YouTube, give us a thumbs up on the video. I'll be very much excited about that. We are growing the YouTube channel. We want to reach as much students as possible. So give us a thumbs up on this video. That is how YouTube will be able to get a signal that the video is engaging and has valuable information, and they'll be able to push it to other viewers across the country, across the continent, and just on YouTube, so that we'll be able to reach more people with this valuable information in relation to that. Okay, so any questions again for me? I guess I'm going to be concluding around this place today for our discussion. Basically, we've been touching solely on financial management. We didn't have any more people coming on board with any questions with strategic case study. But like I said, everything we've discussed today is actually applicable to the strategic case study. So if you are watching on YouTube or you're on Zoom with us and you are doing strategic case study, everything we've discussed so far is valuable for strategic case study. That is why we did the measure as well in relation to that. But we would still have to make an additional time for us to be able to go through the issue in relation to strategic case study, probably sometime later on as we continue with our discussions. So if there are no other questions, I will conclude here today for our discussion. I believe that it was a fruitful discussion for you guys, and I'm able to provide you with some assistance in relation to how you are preparing for your examination. So thank you very much. I think we still have Victor, Owusu, and Jemima on the call here. So thank you very much for joining me, and I'll be concluding here today. In case you've not subscribed to our YouTube channel, make sure you subscribe to the channel. And tomorrow's discussion will also be posted across, so that you join the stream as well tomorrow. In that case, that is if you are doing that subject. On the Zoom chat, I see Victor said, okay, thank you very much. We appreciate that, sir. It's a pleasure. It's a pleasure. So Jemima, Owusu, and Victor, thank you guys for joining the stream. Take care of yourself. Now, for those of you watching on YouTube, thank you also for joining us. Olupo, Steven, and all of you guys, thank you very much. Please, coronavirus is still around. So please, you guys, take care of yourself. Sanitize your hands, social distancing. The case is rising. Even though they speculated that we've reached our peak, it doesn't seem we've reached our peak. So make sure you take care of yourself very well, so that as you prepare for the exams, you stay healthy as well in relation to that. So I'll see you same time tomorrow, 4:30, as we continue with our journey on this in relation to that. So you take care and have a good night.
Hello, sir.
Yeah.
So tomorrow, what are we doing? Will you post it to your page?
Yes, we will be posting it on all our social media platforms. Okay. So you will get a notification on that.
All right, sir.
Okay. So bye-bye, and you take care.